Bitcoin's risk-adjusted return just hit 1.72 while Ethereum crashed to 0.31. That's the widest Sharpe ratio divergence since November 2021, right before ETH dropped 42% in 8 weeks. I pulled the on-chain data at 3 a.m. this morning. What I found in Whale Wallet, 0x8894 changes everything about how you should position for July. In the next 10 minutes, I'm going to show you the exact Sharpe ratio levels that preceded every major ETH-BTC rotation since 2020. You'll see the 3 whale wallets that moved $847 million in the last 72 hours, and I'll reveal the specific price level where smart money is setting their entries. It's not where crypto Twitter thinks. This isn't opinion. This is pure math. The divergence we're seeing right now has only happened 4 times in crypto history. 3 of those times, a violent mean reversion followed within 21 days. Miss this signal and you'll be chasing entries for the rest of Q3. Let me make this crystal clear. The Sharpe ratio measures return per unit of risk. A ratio above 1.0 means you're getting paid well for the volatility you're enduring. Below 0.5 ? You're gambling with terrible odds. Right now, Bitcoin's 30-day Sharpe ratio sits at 1.72. That's exceptional. Ethereum's? A pathetic 0.31. For context, the S&P 500 historically averages 0.89. But here's where it gets crazy. I went back through 5 years of data. When BTC's Sharpe exceeds ETH's by more than 1.4 points, exactly where we are today. Ethereum outperforms Bitcoin by an average of 34% over the following 45 days. Why? Because the market overcorrects. Traders pile into Bitcoin's safety. They abandon ETH at maximum pessimism. Then the rubber band snaps back. This happened in March 2020. It happened in July 2021. It happened in January 2024. The pattern is consistent. But here's what nobody's talking about. The setup requires one more confirmation signal. Now wait, this is the moment that changed it for me. At 2:47 a.m. UTC on June 8th, Wallet 0x8894E3C7 executed a single transaction. 127,400 ETH moved from Binance cold storage to a fresh address. That's $312 million at current prices. This wallet has a perfect track record. I've tracked it for 19 months. It accumulated 89,000 ETH in October 2023 at $1,580 average. Sold 67% in March 2024 above $3,800. That's a 140% gain, while most traders were underwater. Now it's accumulating again. But the destination address is what matters. The ETH moved to a wallet that's interacting with Lato staking contracts. Not selling, not hedging, locking up for yield. Someone with $312 million in dry powder just made a long-term bet on Ethereum at exactly the moment retail is capitulating. But they're not alone. I found 2 more wallets making similar moves, and the total is staggering. Wallet 0x7291 moved $287 million in ETH to Aave lending pools on June 6th. Wallet 0xFA 42 deposited $248 million into Eigenlayer, restaking on June 7th. Combined with 0x8894's move, that's $847 million in 72 hours. These aren't swing trades. These are yield-generating positions. 6-month lockups, 12-month lockups. The smart money isn't just buying the dip, they're committing capital through year-end. Meanwhile, retail exchange inflows hit 89,000 ETH yesterday. That's panic selling, weak hands transferring to Coinbase and Kraken to dump. The divergence between whale behavior and retail behavior hasn't been this extreme since the FTX collapse. And we know how that resolved. But here's the critical question. What price level triggers the reversal? I ran the numbers. There's a specific zone where every previous divergence resolved. Pull up the ETH-BTC chart on the weekly time frame. Look at the 200-week moving average. Right now, it sits at 0.0423 BTC, which translates to roughly $2,847 in dollar terms at current Bitcoin prices. Every Sharpe ratio divergence since 2020 bottomed within 3% of this moving average. March 2020? bottomed 2.1% below. July 2021 bounced exactly on it. January 2024 wicked 2.8% below before reversing. Current ETH price $2,891. We're 1.5% above the level. If we see a final flush to $2,790, $2,810, that's historically been the generational entry zone. But timing matters. The reversals don't happen instantly. On average, price consolidates within this zone for 12 days before the violent move higher begins. So what's the catalyst? What actually triggers the mean reversion? The answer involves a metric most traders completely ignore. Perpetual futures funding rates tell you who's positioned which direction. Positive funding means longs are paying shorts, bullish positioning. Negative funding means shorts are paying longs, bearish positioning. ETH funding has been negative for 14 straight days. That's the longest streak since June 2022. For comparison, Bitcoin funding turned positive last week. Why does this matter? Because negative funding creates a spring-loaded setup. Everyday funding stays negative. Shorts pay a small fee to maintain their positions. This creates pressure. Eventually, the cost exceeds the conviction. When funding flips positive after extended negative periods, the short squeeze is violent. I measured the last 7 instances. Average 72-hour move after funding flip, 18.7% to the upside. We're not there yet. Funding is still minus 0.012%. But historically, the flip happens within 9 days of hitting the 200-week moving average. The countdown may have already started. Here's where the macro picture enters. Spot Bitcoin ETFs have absorbed $2.1 billion in the last 3 weeks. That demand is structural. BlackRock alone holds over 305,000 BTC now. Spot Ethereum ETFs launch in July. The SEC approved the 19B4 filings. S1 amendments are pending. Most analysts expect trading to begin between July 8th and July 15th. Think about the timing. Sharpe ratio at maximum divergence, whale accumulation accelerating, funding rates at extreme pessimism, and a potential $15 billion demand catalyst hitting within 30 days. This is why the smart money is positioning now. They're not waiting for the ETF launch headlines. They're front-running by weeks, but there's one risk that could invalidate this entire thesis. I have to be honest about it. If Bitcoin breaks below $64,200, the correlation regime changes. In risk-off environments, both assets fall together, but ETH falls harder. The 2022 bear market proved this. My risk framework is simple. If BTC loses the 100-day moving average with conviction, the Sharpe ratio divergence trade is off. You'd be catching a knife, not buying a discount. Current 100-day MA. $64,847. Bitcoin trades at $67,200 right now. That's a 3.5% buffer. Not huge, but sufficient for the thesis to remain valid. Watch this level religiously. If it breaks, reassess everything. The math doesn't lie, but the math requires the right market conditions. So here's where we stand. Bitcoin's Sharpe ratio at 1.72 versus Ethereum's 0.31 represents the widest divergence in 31 months. 3 whale wallets moved $847 million into yield-generating ETH positions this week. Funding rates have been negative for 14 consecutive days, a spring waiting to release. The 200-week moving average sits 1.5% below current price, marking the historical reversal zone. And spot Ethereum ETFs launch within 30 days. The last time these 5 signals aligned simultaneously? It's never happened before. We're in uncharted territory with historical parallels all pointing the same direction. The next 21 days will determine whether Ethereum mean reverts 34% higher or breaks down into a broader risk-off cascade. The data suggests the former. But the market will have the final word. Don't miss the next signal. Subscribe to Chain Pulse. Every Sunday, I publish a full market autopsy with whale wallet updates, funding rate analysis, and the exact levels I'm watching. The subscribers who caught the January 2024 divergence made life-changing gains. The algorithm won't show you this content unless you're subscribed. Hit the bell. I'll see you next Sunday with fresh on-chain data. Drop your ETH price target in the comments. I read every single one.